We received regular confirmations that our money was invested in S&P 500 companies. While the return on the account slightly trailed the S&P 500 index, we were assured that the strategy offered adequate diversification and lower volatility. We believe that the U.S. securities market, monitored by the Securities and Exchange Commission, provided protection for our members. Plumbers and Steamfitters Local 267 benefit funds at the time of Madoff's arrest had a market value of approximately $34 million invested with Madoff's direct brokerage. Also, Local 267 had $6.5 million invested with Beacon and Associates. Beacon is a fund consisting of a basket of investments which was comprised of up to 40% of total assets invested in Madoff. Under the current formula of SIPC reimbursement, Local 267 will receive $500,000 for the Madoff direct account. The reimbursement for the Beacon account will only be approximately $900 due to the fact that the amount of Local 267's portion consisted of only 1.8% of Beacon's total assets. To summarize, Local 267's pension lost almost $37 million and is expected to recover $500,900 from SIPC. As the chair of the Board of Trustees of benefit funds, I am regularly solicited by investment managers seeking to advise the funds. Our collective funds pay hundreds of thousands of dollars in fees each year. The securities industry welcomes our collective investments and should be prepared to provide adequate SIPC coverage in the event of a fraud. I must take a moment to reiterate that the only reason why I am here today is that we had money invested with Bernie Madoff. Mr. Madoff has stolen billions of dollars from the Securities and Exchange Commission failed to recognize this criminal behavior even after being investigated half a dozen times from the Securities and Exchange Commission. The reason behind the proposed amendments regarding SIPC treating each pensioner as an individual investor is that pension funds would be made closer to whole to compare what is currently being paid back to pension plans in Central New York. Currently, if all 30 funds receive $500,000 reimbursement from SIPC, a total of $15 million will be returned to the Central New York area, compared to nearly $350 million in losses. 15 million returned, 350 gone. To further illustrate Local 267's pension loss of nearly $37 million, that equates to approximately $33,183 per participant. This protection of pooled investors would not be unique. Similar pass-through account protection is available to individual account retirement plans with funds in the FDIC-insured banks. The portion of the amendment that would require SIPC to reimburse within 60 days would benefit all plans in many ways. This would be accomplished by either returning assets to invest or to pay benefit to retired members. Numerous pension and health funds that were affected by the acts of Bernie Madoff are facing insolvency. The Securities and Exchange Commission was not able to identify the fraud that took place in a timely manner, which resulted in much more significant losses as the criminal act progressed. The Pension Protection Act of 2006 requires pension funds to amortize debt in a 15-year period. I would ask for consideration or relaxation of the Pension Protection Act, allowing a pension plan to amortize the Madoff-related losses at a 30-year rate. That would help ensure pension stability. The plans could recover naturally instead of the plan's solvency being jeopardized, which may ultimately result in the plan being turned over to the Pension Benefit Guaranty Corp. In summary, I strongly urge the consideration for multiple investor groups or participants in multi-employer ERISA plans or any multi-employer investments to be considered as an individual investor, and that SIPC be funded to operate and reimburse in this manner. I also strongly urge that pension plans be allowed the proper time frame before the Pension Protection Act to amortize losses. Thank you very much for your time.
Thank you, Mr. Lancette. And next we'll hear from Dr. John Coffey, the Adolph A. Barrel Professor of Law at Columbia University Law School. Professor. Thank you, Chairman Kojarski, also Ranking Member Garrett, and fellow congressmen. I'm pleased to be here, but disappointed on this first anniversary of Mr. Madoff's death that the federal government has done so little, so very little, to prevent the recurrences of future Ponzi schemes. Ponzi schemes are predictable. They appear to cost American investors, on average, something like $1 billion a year. Before we even heard of Mr. Madoff, in 2002, the Ponzi scheme losses in that year alone were $9.6 billion. So this is not a trivial problem. It's a recurrent problem. And I think it will continue as long as the government persists in allowing investment advisors to be their own custodian. I'll put this just in a sentence because it's not the topic today, but mutual funds have to use an independent custodian. So do hedge funds. Investment advisors are permitted, under the Investment Advisor Act rules, to use a self-custodian. That is, Mr. Madoff used his own brokerage firm. That means his own brokerage firm, Madoff Securities, was serving as the watchdog of Bernie Madoff, the investment advisor. When you are your own watchdog, nothing works. The SEC has taken some modest efforts this year to discourage the use of self-custodians, but they've already backed off under industry pressure. We need a true watchdog over investment advisors, and that can only come from requiring an independent custodian. That's not the topic today, so I'll move on to the Securities Investor Protection Act. Here I want to make 3 suggestions. All of them involve compromises, all of them involve line drawing, and all of them will be painful. But I think we have to make some compromises because insurance is costly, and we can't insure all investors to the full extent of their losses. So, you heard, every member of this panel has told you that the definition of customer under the Securities Investor Protection Act is too limited. I agree that you can expand it. It's understandably limited because if we cover all indirect investors, the system will collapse. CalPERS alone has over $700 billion in assets, and that's just one customer, and there are larger private pension funds. But in looking at who to protect, I think we should look at the continuum of injured victims and see who has been the most injured and is the least able to protect himself. In my judgment, using 2 criteria, I think that is the pensioner in smaller pension funds. Such pensioners suffer the most concentrated loss because they're losing their retirement security, and smaller pensioners can do nothing to guard their own interests, nor do small pension funds have any in-house capacity to monitor. What they do instead is they hire someone like Madoff to be their investment advisor. So on that kind of criteria, who suffered the most concentrated loss, who is least able to monitor and protect himself, I would think the first category that you might think of including, were you to expand the definition of customer under SIPA, would be the smaller pension fund, both Taft-Hartley funds, public funds, and private employer funds, but only, I would suggest, defined contribution plans, because that's where the loss really falls on the individual pensioner and not on the corporate employer who is contingently liable. I think you can feasibly define customer to include smaller ERISA plans, but you'll have to put some financial limit on it. That will be painful, and I'm not going to tell you what that number should be. That's a question for the actuaries. Second point, equally controversial, and you've heard it from everyone else already. This is clawbacks. The SIPA-appointed trustee, both in the Madoff case and in earlier cases like Bayou Funds, will use the fraudulent conveyance actions under the Bankruptcy Code to go after those people who receive very large distributions within the statute of limitations. This morning's Wall Street Journal estimates that Irving Picard will eventually bring suits seeking a total of $15 billion from people who receive distributions within the statute of limitations. That's $15 billion against total losses that Mr. Picard estimates of roughly $19 billion. In other words, fraudulent conveyance statutes have the capability of restoring as much as 80% of the investor's total losses. That's not to say he'll get to 80%, but he has the capacity to sue for 80% of these losses. Maybe if he brings these suits, maybe he'll get 25%, 30%. That's how litigation usually settles. But even $5 billion dwarfs any other source of recovery that the injured investors will receive. Therefore, I'm advising you that you should be very careful before you disable the trustee and cut off his effort to restore these alleged fraudulent conveyances and put them in one common pool for the benefit of all investors. The language that's been offered, the language that says that you cannot bring a fraudulent conveyance action unless, quote, the customer did not have a legitimate expectation that the assets in his account belong to him, is really language that I, as a law professor, believe means you're going to have to show that this person was a co-conspirator of Madoff before you'll be able to bring a fraudulent conveyance action. That would reduce this recovery from $15 billion, in my judgment, to well under $1 billion. Be cautious about stopping the trustee going against the largest source of recovery. That doesn't mean you can't do something. Again, this is a matter of line drawing. I would suggest we start with who are the victims who might be most injured by fraudulent conveyance actions. I would focus here first on charitable organizations. In fact, the Bankruptcy Code, if you look at Section 548, which is the section that principally deals with fraudulent conveyances, has long given an immunity against fraudulent conveyance actions to charitable contributions. Now, charitable contributions are not at issue here. They're usually what's at issue in fraudulent conveyances. Here, these are charities who had an account. They're trying to get their own money back rather than hold on to a charitable contribution. But the principle is there. Congress has recognized in the past that charitable organizations are a special category, and I would suggest that if you're going to do anything in the field of cutting back on fraudulent conveyances, you extend the immunity of charitable organizations beyond simply the contribution and say that a charitable organization cannot be sued for a fraudulent conveyance unless it can be shown that either A, they had actual knowledge of the fraud, or B, the charity was established by, in effect, the crook himself. Let me say one last word about fraudulent conveyances. No one has explained their purpose. They go back to the time of Queen Elizabeth. They've been around for a very, very long time, and they serve one fundamental purpose. They prevent the crook from choosing the victims that will bear the loss. If we don't have fraudulent conveyance statutes, a crook at the 12th hour can still decide to permit some victims to recover by hinting to them they should redeem and letting other people bear the loss. If we don't have fraudulent conveyance statutes, we're going to create very strong incentives for the crook to, in effect, direct who will be the real victims and who will be the token victims. I don't think you want to do that. I don't think you really want to stop Mr. Picard. I think you can use a statute that has a different language, a recklessness test. Today, anyone who's sued in a fraudulent conveyance has a good faith defense under the Bankruptcy Code. The case law has construed that to mean that you've got to show not just subjective good faith, but that you had the good faith of an objective, reasonable person. It's a negligence test. You could soften this down to a recklessness test, as I suggest in my prepared testimony. I think my time is out. The last sentence I'll say is I want to congratulate your chairman. For the first time, Congress in your Section 511 is trying to move SIPC from being a rather strange non-insurance system to a true insurance system that will charge risk-adjusted premiums. You want to charge risk-adjusted premiums because otherwise good brokers are subsidizing crooked brokers. We can't have everybody pay the same amount. We want the riskier broker to pay more. On that note, I'll stop.
Thank you very much. And I want to thank all the witnesses for their testimony. Each and every one of you have told a compelling story on its own, and any of the questions, particularly mine, you know, I'm going to be sort of a devil's advocate, if you will, and not intending to downplay your sufferance, but trying to get to some of the core issues that we're going to have to decide. I think the professor clearly laid it on the line. This is not an absolute guarantee program. And so often we run into, whether you're a victim of a fraud or you're a victim of a market, people want to be made whole. That's a natural human instinct. Our problem is that with the crisis that we've just gone through for the last year, depending on who makes the estimations, the loss in the United States was somewhere between $7 trillion and $14 trillion in capital. And if you had been an investor in one of the major banks in the United States that went from $50 a share to $2 a share because of maybe bad judgment, perhaps investments in the wrong area, or some people would even say potential fraud or participation in fraud. We don't know. That's never been proven. But there would have been great disappointment. It would have been the temptation of every shareholder to say, I want to be made whole at the price I either